Hello guys. In this webinar, I'm going to discuss short strangle and iron condor strategy. So I welcome you all on this webinar. Now, before I start with this session, I'd like to give my brief introduction. My name is Manish Sachdev. By profession, I am a trainer. I take training sessions on CFA Level 1 program and on technical analysis. In my training career, I got opportunity to take training sessions for BSc Institute Limited and for ITM Group of Institution. With BSc Institute Limited, I took training sessions on investment banking program. With ITM Group of Institution, I took training sessions on technical analysis for MBA students. Now, in this session, what I'm going to do, I'm going to discuss a theory part of short strangle and iron condor strategy. Now, what exactly iron condor strategy is? Iron condor strategy is nothing but you can say it is the combination of bull put spread and bear call spread. See, when it comes to option strategies, we have so many different strategies like bull call spread, bull put spread, bear call and bear put spread, long straddle and strangle, short straddle and strangle, butterfly, iron condor. Now, if you want to understand each and every strategy in depth, these 5 points are very very important. So as a trader, for every option strategy we must know these 5 points. Number one, you can see when to design which strategy. As you can see, we have so many strategy. So in which scenario we should design which strategy. Then next, you can see how to design strategy. Number three, you need to also understand break even point. So if you are a buyer in the strategy, so your profit will start only once price cross your break even point. And if you have designed strategy from seller point of view, if price cross break even, your loss will start. So as a buyer, once break even point is crossed, your profit will start. And as a seller, once price cross break even, your loss will start. You also need to understand what is the maximum risk involved in the strategy. And at last, you need to understand what is the maximum reward. So these all 5 points are very, very important for any strategy which you need to understand. Now, in this webinar, I'm going to discuss short strangle and iron condor strategy. So let's first, start with understanding short strangle strategy. Now, as I discussed, in this webinar, I'm only going to cover theory part of strategy. So all these 5 points I will discuss in depth. Now, let me show you the backtesting result. Let's say if you are designing, this strategy practically in live market in Bank Nifty, then this is the backtesting report. See, we have backtested, this strategy for last 4 years from January 1st, 2017 till 22nd December 2020. So we have backtested this short strangle strategy in Bank Nifty for last 4 years. And here is the result. Overall profit delivered by short strangle strategy in Bank Nifty is 4,25,875 rupees. Look at the win percentage. Win percentage is very close to 75. And look at the loss percentage. Okay, win percentage, exact number 73. Loss percentage, you can see it is 26 percentage. This is the maximum profit, maximum loss, average profit, average loss. So today's session, I'm going to cover only theory part of this strategy. If you want to learn practically how to implement this strategy in live market in Bank Nifty, then we are conducting live session on 27th December. I will share the details in some time. So let's first start understanding the theory part. If these 5 points are clear to you, then only you will able to implement this strategy in live market. So let's first start with understanding when to design short strangle strategy in Bank Nifty. See, you need to design this short strangle strategy in Bank Nifty when you expect Bank Nifty will move sideways. So as a trader, if you are not expecting huge volatility on either side, either on upside or on downside, then you can design short strangle strategy for bank nifty, and if bank nifty moves sideways, you can earn profit. Okay, theta decay will be your profit. As you might be aware of, due to passage of time, both call option as well as put option will lose their value. So as a seller, we can make profit out of that. So when to design short strangle strategy in bank nifty? We can design this short strangle strategy in bank nifty when we expect bank nifty will move sideways in coming trading sessions. Now let's understand how to design short strangle strategy. See, now to design this strategy, what you need to do, you need to sell call option, and also you need to sell put option. Okay, you will sell both call option and put option. Now both options will be OTM. So you need to sell OTM call option. At the same time, you also need to sell OTM put option. Now when you sell, both call option as well as put option, you will receive premium. So there will be net credit to you. That I will discuss later on in detail what exactly is net credit. So as of now, I have covered these 2 points: when to design, when you expect bank nifty will move sideways; how to design, you need to sell OTM call as well as OTM put option. Okay, now let's understand in better way. Let me take some number for you. Let's say, for example, bank nifty spot currently trading at, let's say, 29,952. Okay, this is the spot price. Bank nifty spot currently trading at 29,952. Now you need to select, guys, nearest strike price, or in other words, I will say you need to select ATM strike price. So if bank nifty spot is 29,952, I can say ATM strike price is 30,000. As you can see, this is more than 50. 29,952 is greater than 950. So we need to do round off. So the nearest strike price will be 30,000. If it was less than 29,950, if this value was less than 29,950, then nearest strike price would have been 29,900. So let's say, for example, if I'm keeping this 29,948, if bank nifty spot currently trading at 29,948, here I can take ATM strike as 29,900. So let's keep this number now. Bank nifty spot 29,948. So the nearest strike, or I can say ATM strike, is 29,900. Now we need to sell OTM call and OTM put. Now how to decide, strike price, which OTM call, which OTM put we should select. See, for that we need to do adjustment of 100 points. ATM strike price is 29,900. So for call option, you need to add 100 points. So that will become 30,000 call. Strike for call option will be 30,000. So I can write here, we can sell call option with strike price 30,000. Same thing we need to do for put option. We need to do adjustment of 100 points. So for put option, we will minus 100 points. See, for call option, we have to add 100 points to make it out the money. For put option, we need to minus 100 points to make it out the money. See, this 29,900 strike price is at the money, but we want to sell both call and put OTM, that is out the money. So to make it, options out the money, we are doing adjustment of 100 points. For call option, we need to add 100 points. For put option, we need to minus 100 points. Then only both call option and put option will become OTM, out the money. Now here you can see we have selected, completely different strikes for both call and put. Therefore, the name of strategy is short strangle. So short strangle basically means we are selecting different strike price for both call option as well as put option. and we are selling both options. So the name is short strangle, as we are creating sell position. Now, when we sell, both call as well as put option, we will receive the premium. As a seller, we will receive the premium. So let's assume now this 30,000 strike price call option is trading at, let's say, 300 rupees, and this 29,800 put option is also, let's say, trading at 300 rupees. So combining together, how much premium we got, guys? We got 600 rupees. So I can write down here the net credit is 600 rupees. So as an option seller, you need to remember, when we sell option, we will receive the premium. As a buyer of option, we have to pay the premium. But in this case, we are seller. We are selling both call as well as put. So we will receive the premium. So combined premium, we have received 600 rupees. Now let's talk about break even point. What will be my break even point? Now guys, there will be two break even points. Okay, one will be upper break even point from call option point of view. Another will be lower break even point from put option point of view. Let's first focus on upper break even point. So formula to calculate upper break even point is call strike plus net credit. So in this case, you can see call strike is 30,000, net credit is 600. So I can say 30,600 is my upper break even. Now let's calculate lower break even. So formula to calculate lower break even is put strike minus net credit. So put strike is 29,800 minus 600. 29,200 is your put option. 29,200 is break even from put option point of view. Now let's understand in detail what exactly 3,600, 29,200 represent. See, as long as Bank Nifty is trading between 29,200 to 3,600, as a seller, I am not in the loss. My loss will start once Bank Nifty cross 30,600 on upside or 29,200 on downside. So once break-even points are crossed, then as a seller, our loss will start. Now, how much can be the loss? The loss can be unlimited. So let's say if Bank Nifty closed at 3,700 on expiry day, then my loss will be 100 points from this strategy. With lot size 25, my loss will be 2,500. If Bank Nifty, let's say, closed at 29,000 on expiry day, then my loss will be 200 points. As you can see, 29,200 is lower break even. So once Bank Nifty goes below 29,200, my loss will start. So if it closed at, let's say, 29,000 on expiry day, my loss will be 200 points. So again, with lot size 25, my loss can be 5,000. So until and unless Bank Nifty is not crossing these two break evens, as a seller, we are in profit. So right now you can see Bank Nifty is trading at 29,948. If it crossed 3,600, then my loss will start. If it crossed 29,200 on downside, then my loss will start. So here I can write down for you. If Bank Nifty is trading, or let's say if Bank Nifty closed between 30,600 between 29,200 to 30,600. Okay, this is the range. If Bank Nifty closed between 29,200 to 3,600, then then as a seller, we are in profit. Once it cross 29,200 on downside, or 3600 on upside, then as a seller our loss will start. Now let's talk about maximum risk, maximum reward. Okay, from this strategy, what is the maximum risk and what is the maximum reward? See, maximum risk, as I discussed, it is unlimited. Okay, but we have solution for this. If I'm designing this short strangle strategy in live market, I can control my risk by having right stop loss. So in my live sessions, I'm going to discuss what should be the stop loss. Maximum reward will be net credit. So in this example, you can see how much is the net credit, guys. Net credit is 600 points. So this can be our maximum reward. With lot size 25, you can calculate how much can be your maximum risk. So 600 into 25, your maximum reward can be 15,000. So as a seller, I cannot earn more than 15,000 from this strategy. Now here you need to understand when maximum risk will happen and when maximum reward will happen. See, maximum risk will come in picture once Bank Nifty cross these two break evens. Either it should cross 29,200 on downside or 30,600 on upside. Then your maximum risk will be unlimited. Let's talk about now maximum reward. When this maximum reward will happen? See, maximum reward will happen on expiry if Bank Nifty closed between strikes which we have sold. So we have sold 30,000 call option and we have sold 29,800 put option. If on the day of expiry Bank Nifty spot settled between these two values, okay, between 29,800 to 30,000, then as a seller I will earn maximum reward. Let me write it down for you. Maximum reward will happen on expiry if Bank Nifty spot closed between 29,800 to 30,000. So we discussed on this slide when to design. So when I'm expecting Bank Nifty will not give me major move, I can design short strangle. How to design? We need to sell both call option and put option. We need to sell out the money call as well as out the money put option. Now when we sell, these two options, as a seller we will receive premium. So here you can see this is the net credit, and this can be our maximum profit. As a seller we cannot earn maximum profit more than 600 rupees. Then here you can see we have two break-even points. One is upper break-even point, and other one you can see it is lower break-even point. What is upper break-even point? Upper break-even point is 3600. Lower break-even point you can see it is 29,200. So as long as Bank Nifty is trading between these two values, I don't have to worry at all. My loss will start once it crossed 3600 on upside or 2200 on downside. How much loss can happen, guys? Loss can happen unlimited. As here you can see, maximum loss is unlimited. If Bank Nifty on the day of expiry closed above 3600 or below 29,200, then our loss will start. So if it closed at, let's say, 31,000, your loss will be 400 points. If it closed at 31,500, your loss will be 900 points. In the same way, if it closed at 29,000, loss will be 200 points. If it closed at, let's say, 28,600, loss will be 600 points. So beyond these two values, our loss will be unlimited. Now, when maximum reward will happen? Maximum reward will happen if Bank Nifty spot settled between strikes which we have sold. So on the day of expiry, if closing is coming between 29,800 to 30,000, then as a seller, I will earn maximum profit because I have sold, call option and strike price is 30,000. So if I have sold call option with strike price 30,000, this means my view is Bank Nifty will close below 30,000. On the other end, I have also sold, put option with strike 29,800. If I have sold strike 29,800 put, this means my view is Bank Nifty will close above 29,800. So I am expecting Bank Nifty to close above 29,800 but below 30,000. So if on the day of expiry, if Bank Nifty settled between these two values, I will earn maximum profit. As a seller, we can earn maximum profit as premium received. So in this example, you can see the premium received is 600 points. With lot size 25, my maximum reward can be 15,000. So now this was the exact theory part. So as a if you are designing this strategy as a trader, you must know all these points. So now you know very well when I'm designing short Strangle strategy. Then what is the break-even point? What is the maximum risk? What is the maximum reward? You also know when to design short Strangle strategy and how to design. Now, when you implement this strategy every week in live market, you can achieve this much result. As you can see, this is the backtesting report. So overall profit, once again, you can see 4,25,875. This is the total profit delivered by this setup in last 4 years. So when I will take live session, I will discuss in depth when to design this strategy, whether we should design this strategy on Friday, whether we should design strategy on Monday, Tuesday, Wednesday, when we should design this strategy. Now let's talk about margin required. If I'm designing this short Strangle strategy in Bank Nifty, let me tell you how much is the margin requirement. See, margin requirement will be 1,50,000. So if as a trader you have this much of capital, 1,50,000, this is the best setup you can design every week in Bank Nifty. If you do not have 1,50,000 capital, so what to do now? We have solution for that. So instead of designing short Strangle, what you can do, guys, you can design iron condor strategy. Now, when you design this iron condor strategy instead of short Strangle, margin required will be between 40,000 to 50,000, not more than that. Okay, this is as per Zerodha. Maybe it will be between 40 to 45,000 also, but it will not be more than 50,000. It will be in the range of 40 to 50,000. Now, what is iron condor strategy, guys? As I told you in the beginning, iron condor is nothing but it is the combination of bull put spread and bear call spread. So again, let's discuss when to design this iron condor strategy. We need to design this strategy again when we expect Bank Nifty will move sideways. There won't be any major move in coming days in Bank Nifty. So I can design iron condor strategy instead of short Strangle just to get margin benefit. Now let's see how to design this strategy. Okay, how to design strategy. Again, let's say current market price of Bank Nifty spot is 29,948. Okay, so guys, what will be the ATM strike? ATM strike will be 29,900. So sell call option, sell put option. Again, you need to do the adjustment of same 100 points as we will sell both OTM call and put. So sell call option 30,000 strike, sell put option 29,800 strike. Let's take it same premium, 30,000 strike call trading at let's say 300. 29,800 put option is also trading at 300. Now guys, what we will do, if I have sold call option 30,000, then this is called as naked position. Now in order to hedge this position, at the same time I will also buy call option. I have sold call option with strike price 30,000. Now to protect this position, to hedge this position, what I will do, I will buy call option with strike price 30,500. So on one side, I am selling 30,000 strike call. On other side, I am buying 30,500 call. Now, why I'm buying this 30,500 call? Let's assume we got one side strong rally in bank nifty on upside. Then no doubt I will make loss in this position, but I will earn profit in this position. This 30,500 call option will protect me to some extent. So I can set off my loss, whatever loss I will bear in this position. I can set off this loss by making profit from this position. So this is my insurance, you can say. So as you can see now, this position is completely hedged. So therefore, margin requirement will be very less. So let's say now this 30,500 strike is trading at 100 rupees. If I'm selling call option 30,000, I will receive 300 rupees. If I'm buying call option 3,500, I have to pay 100 rupees. So net credit from this position is 200 points. Same thing we need to do for put option. I sold 29,800 put option, 300 rupees. Now this is the naked position. To protect this, what I will do, guys, I will also buy 29,300 put option. If I'm getting one side strong rally in bank nifty, let's assume this rally happened on downside. So again, this position will give me loss, but I can make some profit in 29,300 put as I'm buying this. So this again, this position will protect me to some extent. So let's say this is also trading at 100. So I received 300 from this put position. I need to pay 100 to buy 29,300 put option. So again, the net credit from this position is also 200. Now look at the strike spread. You can clearly see we have kept 500 points spread. I sold 30,000 call, I bought 3,500 call. So the strike difference you can see is 500 points. So this difference between strike prices is nothing but you can say strike spread. Same thing you can see in put option. I sold 29,800 put. I bought 29,300 put. So again, the strike spread is, guys, how much points? 500 points. Now there is no fixed rule that you need to keep 500 points strike spread. If you wish, you can keep 400 points spread. If you wish, you can keep 600 points spread. So there is no fixed rule that you need to keep 500 strike spread. So net credit from this strategy, guys, is it is 400 points. Now let's discuss what will be the maximum profit. So again, as a seller, our maximum profit will be 400 points. Okay, not more than that. So with lot size 25, my maximum profit will be 10,000 rupees. Now you need to understand when this maximum profit will happen. Okay, this maximum profit will happen on expiry if bank nifty closed between strikes which we have sold. So if bank nifty spot settled between 29,800 to 30,000, same as we discussed in short Strangle. Now let's talk about maximum risk. See, in short Strangle strategy, I told you maximum risk is unlimited. But in iron condor strategy, our maximum risk is limited. You know in advance how much you will lose. Let's calculate what is the maximum risk in this example. So in this example, the maximum risk is strike spread minus net credit. So here you can see strike spread is 500 points, net credit is 400 points. So maximum risk is 100 points. So with lot size 25, maximum I can lose 2,500. So if I'm getting very strong rally on upside or on downside, my maximum loss is fixed. I cannot lose more than 2,500 points from this strategy. Now you need to understand when this maximum loss will happen. See, maximum loss will happen on expiry if bank nifty closed beyond strikes which we have bought. So you can see we have bought 3,500 call, 29,300 put. So on expiry day, if Bank Nifty closed above 3,500 or below 29,300, then maximum loss will happen, and which is 2,500. So on expiry day, if Bank Nifty closed below 29,300 or above 30,500, okay, then this maximum loss will happen. Now let's calculate, guys, upper break-even point and lower break-even point. So upper break-even point is call strike minus net credit. Okay, call strike which we have sold. So we have sold 30,000 call strike. 30,000 plus 400. 30,400 is my upper break-even. Lower break-even point is put strike minus net credit. Okay, here it will be call strike plus net credit. Sorry for this. And lower break-even point will be put strike minus net credit. So 29,800 minus 400 points. 29,400 is my lower break-even point. So as long as Bank Nifty is trading between if Bank Nifty is trading between 29,400 to 30,400, as a seller, I am in profit. Now let me show you the backtesting report of Iron Condor strategy. So even Iron Condor strategy we have also backtested for last 4 years, starting from January 1 to December 22. Overall profit generated by this strategy in last 4 years is 1,91,875. Win percentage 65, loss percentage you can see 35 percentage. Now let me show you monthly breakup. So here you can see this is the entire year 2017, 2018, 2019, 2020. At the end of every year, if you net off at the end of every year, you are in net profit. Same is the case with short Strangle strategy. So you can see at the end of year 2017, 58,776 is the profit. At the end of 2018, 70,761 is the profit. At the end of year 2019, 1,30,540 is the profit. At the end of 2020, this is up to 22nd December 2020, 1,65,798 is the profit. So overall profit from short Strangle strategy is 4,25,000. This is the monthly breakup. So it may happen that at the end of month you may face loss, like in 2019 I can see in the month of June 7,124 was the loss. Again in the year 2020 June month you can see the loss was 25,000. So at the end of month there may be loss sometimes, but at the end of year you can see this strategy has never delivered a loss. And just look at the accuracy, 73% win percentage, 26 to 27 percentage is loss percentage. So this was the basic theory part. If you want to understand how we can implement this strategy live, what you can do, guys, you can WhatsApp me with your name on this number. I'm going to take this session how to implement both these strategies in live market. So one was short Strangle and one was Iron Condor. Margin requirement for short Strangle is 1,50,000. If you do not have that much capital, if you have margin constraint, you can better go for Iron Condor strategy. So in this, margin requirement will be between 40 to 50,000. So if you want to really understand how you can implement this strategy in live market, you can join me. I am taking this live session on 27th December at 5 p.m. Okay, here you can see the date, 27th December 5 p.m. In case you are watching this video after 27th December, if you have missed to attend my live session, you can WhatsApp me your name on this number. Fees is just 1,000 rupees, and both these systems, both these strategies which we have discussed are mechanical trading system. Just you need to design this strategy and leave it till Thursday, that is on the day of expiry. So when we should design, both these strategies, whether we should design strategy on Friday, Monday, Tuesday, Wednesday, which strike price we should select, all these things we are going to discuss in my live session. Where to keep stop loss? So if you are designing short strangles, so there is need to keep stop loss, because there is always overnight risk. But when you are designing iron condor strategy, there is no need to keep any stop loss, as your position will be hedged. So if I have sold 30,000 call option, I have also bought 3,500 call option, so my position is completely hedged. I don't have to worry. There is no overnight risk at all, and my loss is very limited. You can see I cannot lose more than 2,500 in this strategy. Now this is as per this example. Now if you implement this strategy in live market, your maximum loss can go till 4,000 also. So your maximum loss, maximum profit is depend on the premiums which we will receive, and the premiums which we will pay. So these are the approximate premiums I have taken. Now if you want to learn all option strategies, so I take 4 days live sessions for that. See, if you want to learn only short strangle and iron condor strategy, so there will be only one session for approximately 1 or 1.5 hour, and fees for the same is 1,000 rupees. If you want to learn all option strategies, then I will take total 4 days live session. Now during these 4 days, these five topics I will cover. So you will learn bull call spread and bull put spread, bear call and bear put spread, short strangle, iron condor. So 1, 2, 3, 4, 5, 6, total 6 strategies you will learn. And you will also learn 3 swing trading setups on daily chart. Now based on these setups, you can design these strategies. So to learn all these 6 option strategies and 3 swing trading setups on daily chart, the fees is rupees 1,500 only. So guys, if you are interested, you can contact me on this number. We will start your sessions at your convenient time. You will also get PPT and recordings after the session. That's it in this video. Thank you guys. Thank you very much for your time.